Hello class, welcome to Chapter 7, Business Expenses and Deferred Compensation. This chapter, the learning objectives are to understand the deductibility of business and rental real estate activities, distinguish the classifications of employees and independent contractors, determine the proper deduction amount for travel expenses, understand the deductibility of transportation expenses, understand the deductibility of business meals and the 50% disallowance rule, identify deductible moving expenses, describe the requirements for deducting education expenses, determine whether the expenses of an office and a home meet the requirements for deductibility and apply the gross income limitations. Discuss the tax treatment and requirements for various deferred compensation and arrangements. Describe the tax planning considerations for business expenses and deferred compensation. Describe compliance and procedural considerations for business and deferred compensation expenses. Types of expenses for employees. So that's going to be the EEs. So you have two types. You have the reimbursed, which is the expense incurred by the EE, or you have reimbursed by the employer, which will be referred to as ER. The employee can deduct for AGI if amounts were taken into income. The unreimbursed expenses incurred by EE, not reimbursed by the ER, not deductible, starting in 2018. So keep in mind with the this is going to be for AGI, okay? So this is going to be the ones that's going to be on page 1, okay? Not the from, which would be on the Schedule A. Employer-employee relationship. Definition of employer-employees. You're going to need to know about the proper classification of employees, and then you're going to have IRS action. Deductibility of travel expenses. You have self-employed, so that's going to be deductible for AGI. Employee, not deductible if reimbursed and start in 2018. Personal is not deductible. The following slides pertain primarily to the deductibility of business expenses for self-employed individuals. So keep in mind the self-employed part, deductible for AGI, it's deductible for AGI because it's going to be on the Schedule C, which would be on the top of your 1040. And remember, in 2018, starting in 2018, they did away with the unreimbursed expenses that normally goes on your Schedule A. Requirements for travel deduction. Expenses must be business related. Worker must be away from tax home for sufficient duration to require sleep before returning home. So it has to be something that's away. Can't be someone that is local and you just felt like going to a hotel. It has to be for business related and you are away. The away from home, where's your taxpayer's home? So that is going to be where is your primary residence and where you're going to be, where is your main place that you're living. You have temporary versus indefinite versus permanent. And then you have the definition of what overnight is. Away from home requirement, this is part 2, is temporary, okay? So travel expenses are deductible, and then indefinite is tax home shifts to work, assigned to workplace. Travel expenses are not deductible. So if you're going to be, if it's indefinite and you have to move to another spot and you're going to be there for a long period of time, then that's going to be your workplace. Other travel expense limitations. You have foreign travel, general education trips, transportation on luxury water vessels, and conventions or meetings on cruise ships. So you have to be leery on that when you're going to do something extravagant like on a cruise ship or luxury water vessels. Okay, so there's limitations on there. The transportation expenses. So the example, the taxpayer can deduct transportation of cost of 10 miles even if he goes home between jobs. Okay, so you're going to start at your home and then you're going to go to your job. So that's 5 miles. But then once you get to your job, then you're going to go to job 2. This is where your mileage would kick in. From your tax home to your regular job is not. You can't just take your mileage every day, but you can take it. Once you get to your job and you have to go somewhere else, that's when you track your mileage. Okay, so then you will go home. All right, and then your second job is, well, what you would do is on this, if you're going to a different location, you would need to subtract the 5 miles off of your first job, and then so that would be your 3 miles on there. Automobile expenses, you have actual, you have depreciation, you have gas and oil, repairs and maintenance, insurance, and license fees. The standard mileage was 58 cents per mile. You can take your parking, you can take your tolls, you can take your interest expense, and you can take your personal property. Entertainment and club dues. Entertainment expenses are no longer deductible starting in 2018. No deduction allowed for cost to build or maintain entertainment or recreation facilities. Example, skyboxes or sky lodges. No deduction allowed for club dues, airline clubs, golf clubs, social clubs, and can deduct dues for professional, civic, and public service organizations. An example is the Chamber of Commerce and trade associations. So you used to be able to go, say, to a ball game, and you pay for your clients' tickets and you pay for the food. No longer can you deduct the price of the ticket. You can take the food, you can take the drink, all the beer and hot dogs you want, but you can't deduct that ticket anymore. Meals generally deductible, limited to 50%. So going back to that example with the taking someone to a ball game. So if it was $100 you spent on your meals, 50% of it could be an expense, and the other 50% is going to be not deductible. All right, so it's going to have to be ordinary and necessary, cannot be lavish or extravagant. Taxpayer must be present when the meal is provided. Food is provided to the client or potential client. Food must be billed separately if provided with entertainment. Meals purchased while traveling away from home are also deductible. Business gifts, deductible up to $25 per donee. Amounts less than $25 are disallowed. Or greater, amounts greater than $25 are disallowed. No subject to 50% reduction. Employee achievement awards that are under $400 per individual are deductible. Employee business expenses. You have accountable versus non-accountable. So on the accountable, you have substantiation of the EE must be adequate to accounting to the employer. Employee must return excess reimbursement. The non-accountable is the reimbursement is included in the EE's gross income. The employee cannot deduct these amounts. If you're getting reimbursed for something, you can't take that as an expense. Accountable plans. Reimbursements are included for gross income and expenses are deductible for AGI. So that's going to be above the line. You can use per diem allowances for meals and lodgings expenses in lieu of actual expenses. Taxpayer needs only to substantiate the time, the place, and the business purpose of the trip. No other receipts of actual costs are needed. Requirements for moving expenses. Starting in 2018, moving expenses are not deductible to both self-employed individuals and employees. The exception is taxpayers who are actively serving in the armed forces may deduct moving expenses. So due to people playing with those numbers, they took that away. And unless you are in the armed services and you get moved to another base, then you could take moving expenses. Exceptions to the general rule of non-deductible of education expenses. You have tax credits, student loan interest, excludable scholarships, employee education assistance, limited deduction of higher education, qualified state tuition program, and the Coverdell IRAs. Requirements for deductibility of education expenses. You're going to maintain, improve skills for trade or business. Expenditures required by employer or imposed by law. Okay, so those are the two. But it's not deductible if the education meets minimum educational requirements for employment and the education qualifies the taxpayer for a new trade or business. Home office. So you got to meet one of the following. The office must be used as the principal place of business. Office is located in a separate structure, not attached to a dwelling, must be used exclusively and regular in the trade or business, and the office must be used as a meeting place for patients, clients, or customers. All right, so you cannot have a office, say, in Dover or in Wilmington, and then you have a home office and start working from home and take that deduction. Types of home offices expenses. You have the direct, which is the expenses relating only to the office, dedicated fax line, painting the office. Indirect is the pro rata share of expenses that benefit entire dwellings, real estate taxes, insurance, utilities, and maintenance. So for the home expenses, you can do the simplified method, which is a formula, and you can go and it'll you go by your square footage of your house, and there's a ratio that you would take, or you can take each individual expense lines. Calculating the home office deduction. Home office must be for the convenience of the employer, not the employee. The total home office expenses equals 100% of direct expenses plus the pro rata share of indirect expenses. And then you have your safe harbor. Instead of deducting direct plus indirect, the taxpayer can deduct $5 a square foot, maximum of 300 square feet for home office expenses. Types of deferred compensation plans or other retirement vehicles. You have your qualified plans, pension plans, profit sharing plans, 401k plans, stock bonus, ESOPs. You have plans for self-employment taxpayers. You have the Keogh accounts, SEP IRAs, simple plans, solo, and 401k plans. And then you have non-qualified plans, deferred executive compensation plans, employee stock option plans with substantial risk of forfeiture. Type of qualified plans, you have contributory versus non-contributory. You have defined contribution versus defined benefit. So those are your pension plans. Your profit sharing, you have typical, a 401k plan, which includes a Roth type plans, and then you have your stock bonus plans, which is your ESOPs. Qualified pension plans, you have defined benefit. That plan pays a fixed amount to the employee based on certain formulas. This sometimes can called a traditional pension plan. Or you have your defined contribution plan, which is the employer pays a fixed amount for each employee based on a formula. The amount of retirement benefit depends on how much the investment grows in the interim. Qualified profit sharing plans, Section 401k plans are the most common type of the profit sharing plans. There must be a definite formula to allocate the ER contributions. The employee must have options to take compensation in cash or contribute to the plan. The employer does not have to contribute annually, but is required to make substantial and recurring contributions. Roth type profit sharing plans, the employee can contribute after tax dollars. Amounts in the plans are not taxed, and distributions are also tax-free as long as the account has been active for 5 years or more and the employee is greater than 59 and a half years old. So you already received the money and was taxed on it, and then you contributed into the plan. So that is why the plan is not taxed.